am not typically in the business of being the clerk, so I rely on JP for his expertise.
Hey, Tori, if you go in the team screen, if you go into the in the upper bar where the three dots are, the more bar, there's
Tiffany found it.
a record and transcribe if you want to record it.
Perfect.
Yeah,
Yep.
it started.
Tiffany found it.
Okay.
Okay, all present.
Is that an extra one?
Yeah.
Okay, thank you.
Set one in for you. I'm sorry
Okay.
about that.
Thank you. Next, please join me in the Pledge of Allegiance. Would you?
There's a flag in one of these two offices here.
Okay.
Right? So we'll pledge to
You want
Joe's.
to pledge in that direction?
Yeah, pledge in that direction.
Okay.
I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
I'm going to order us a 99-cent flag.
Item number 4 is communications from the public. Anyone who wishes to address the Board of Trustees regarding items listed on the agenda and not on the agenda may do so at this time. Public comments are temporarily limited to 2 minutes. Please state your name when the chairperson calls for public comment. When you're recognized, you may proceed with your comments. The Board of Trustees is prohibited from taking action or discussing any item not appearing on the agenda. The Board of Trustees may take action to direct staff to place a matter of business on a future agenda. Do we have any communications from the public?
I don't have any requests from the public.
Seeing none, we'll move on to item number 5, new business. Item 5A is to discuss and select the chairman for the Investment Oversight Committee. And I don't think we need to discuss the staff report, it's pretty basic, so I guess I'll ask for a motion for, or a
Nomination.
nomination for chair.
I would like to nominate Carol Kendrick.
Do we have a second?
I'll second it.
And then a roll call vote. Or all in favor, say aye.
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 All opposed? Carol Kendrick is the chairperson for the Investment Oversight Committee.
So now we need a vice chair.
Yes, so I will take nominations for vice chair.
I would nominate Jackie
I'll second.
for vice chair.
All in favor, say aye.
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 Opposed? That passes with Councilmember Peterson as vice chair for the Investment Oversight Committee. Item number 6 is unfinished business, 6A. And if we can get a staff report on that.
Sure. The last time, good afternoon, by the way, the last time we sat down at this table, we were going to discuss whether or not the committee wanted to recommend to the council that there be changes to the responsibilities in the current investment policy for the function of the treasurer. As of now, the city treasurer serves mostly a ceremonial role for the city. And before we sat down for that specific, or as we were sitting down for that specific conversation, we were also on the verge of a special meeting regarding the city treasurer as well. So at that time, Mr. Prestwich had recommended that we table this conversation and come back at a later date, which is today. So that way we can revisit whether or not the committee has any discussion or recommendations on making changes to that those roles and responsibilities.
Any discussion?
I looked it over earlier and I don't see anything in particular, but I'm rather new, so I don't know all the ins and outs. But to me, it looked pretty normal.
Yeah, I didn't have any comments.
Dale, did you have any thoughts?
Well, not necessarily. There is history to the treasurer's position since the treasurer had been here for so many years that everybody really loved. Did a great job. The treasurer that followed her, there was controversy. And so there was kind of a battle between the treasurer's office and the city council for quite a period of time, to the point where she finally resigned. And I was approached to become the treasurer and I didn't want to do it. I said, get a hold of Howard Fagenbaum, your neighbor out there. But he already had, and he'd said no. And so I said, okay then. And what basically it was just a matter to avoid a special election and the cost of it. And it would have been expensive. So I did that. By the time I was sworn in, there were duties on the website. If you look at the Emmett Treasurer website, there were duties for the treasurer. But by the time I was sworn in, that had been taken off. And so it was a ceremonial role from there on. I talked to Carly about, Carly and I were good friends, and said, Carly, what's going on with the treasurer? Why are you even paying a treasurer? And so that's where we are today. And, you know, I do go over the reports. It's just, but I'm open for whatever. You know, I don't know what the city council wants to do with the treasurer going forward. So I have strong thoughts about the treasurer, but the treasurer in Hemet is set up just for investments. And now you have this group doing investments. And I'm all for that. I'm not against that because it's become more and more complex, partly because of the state, and state has a way of making things complex. So you could easily get yourself in trouble. And I don't think the one person can handle it either, you know, as it could in the past. So that's where you are today. So the city council has to make a decision on how you'd like to go forward. I would say this, and I assume you folks have talked to your attorney about this, but if you look at the city org chart, the treasurer is outside of it's people to the treasurer, and then there's a line to the city council. The city council apparently had the ability to appoint a treasurer, but I don't think at the next election coming up, it appears, just looking at the org chart, that it would go back to a regular election again.
Mm-hmm.
That's right. It would be up for a member of the public to be appointed, to be elected.
To be elected.
Mm-hmm.
And I think we're out of time. If we were going to do something different, it would have had to come on the primary ballot. We're too late for that.
Right. Well, we had the special meeting and it was voted down, so.
Yeah, it was voted.
So everything's status quo.
Exactly, yeah. So that's where we are as treasurer today. If you wanted to assign your treasurer some duties in your package, you do have a suggestion.
Can you tell me a little bit about your background?
I'm 40 plus years in construction, 20 years in residential, 20 years in commercial. In commercial, well, and besides that, since retirement, I've been treasurer for several nonprofits in a variety of ways. Of course, most nonprofits, the treasurer duties there encompasses everything dealing with the money. So they look to you to make sure the books are balanced and everything is deposited on time. But in construction, especially the last 20 years in the commercial business, I worked for a very large company, and a big part of our job was watching budget, making sure that we were on budget, hopefully under budget. Our bases were both based on that. Our bonuses were based on being under budget. And so money's a big deal to me. I mean, it's not only in my family budget, but money's a big deal just in general. We just talked briefly about the city has talked about increasing their reserves from 20% to 40%. That's a very worthy goal. I'd love to see that happen because our past history, we've been tight on money and all that. But can you achieve that? Is it a realistic goal? And so that would be a decision for other people. Where normally a treasurer would get involved in that kind of stuff, be sitting, no, where are we going with our dollars? But for the city right now, the city of Hammond with this firm on board, which I think is a wise thing, I don't see much of a role for the treasurer right now.
So in the staff report, it says that you review the warrants.
No, not at the present time. Now, there's nothing on the website that I'm aware of that there's no duties on the website that I'm aware of. I've set it up, and I work at home. And I work at home partly because not only can I go over reports like this, and I've gone back into 2022, I have all the reports and checked them out and see where we're at and all this and that. And then we talked recently about slight adjustment here and there. But you've got great reports and everything is going along swimmingly. So I've kind of invented work, you might say, in a way. But in order to find out where we stand, and also dealing with the public, my friends, and through my local political stuff that I'm involved with, we try to bring information to the folks we're with. We try to be factual, not like you can go to some meetings and everything is going along good, but it's not really going along good. You get reports that's going along good. So we need to be factual with our people, of course. But I'm not sure I would fit in the role of looking at the warrants. I don't know. It looks like a lot of work, and I'm not sure. We'd have to talk about that too.
Yeah.
Yeah.
Yeah, that says that in the staff report. So I guess one of my questions would be is, do we have a job description?
The code speaks to that. So I'm looking at it now. It's section 2.159, and it says duties. But essentially, the city council can delegate responsibilities to the treasurer or other such person as determined by resolution of the city council for the investment work. And then there's a statement later in this that says the treasurer has no duty to perform any of the fiscal and budgetary functions of the city that are performed by the Department of Finance. But the last clause says the city council may by resolution assign additional responsibilities to the city treasurer. So it may be reasonable for us to identify and build a set of duties that could be helpful as a check and balance on certain work that's done, and consider recommending those, first at the committee level, and then later to the city council for adoption by resolution that would prescribe the duties. And if we have that done before the election, which would be in November, that could be very helpful to the candidates, but maybe also in recruiting candidates to run for the seat.
Can we look at what other cities' treasurers' roles are? I mean, I just want to make sure we're kind of in line with our neighbors. And
it would be good to look, and I would agree with that. And I think what we really also want to understand is, especially those that are elected today, how are cities identifying the roles and responsibilities for the treasurer when a lot of that work is delegated to either professionals or finance staff, because it's often one or the other. So we'll work on bringing back information.
I can tell you that San Jacinto, their treasurer is not exactly ceremonial, but it's just a small stipend that they pay the treasurer. Michael Vanderlyn, a friend of mine, is treasurer down there. And so Michael and I talk once in a while. He does occasionally there's things in their charter that there's certain things that he has to sign, but it's not a regular full-time job.
Yeah. I think it would be great if we had a new set of, what we expect of the treasurer, because I thought you looked at the warrant register because the staff report said it. I wasn't really sure what all you did. So.
Well, I mean, you've told me that you looked at the warrant registers in standalone conversations, as well as reviewing the treasurer's.
Well, I get I'm
not necessarily
a nosy guy. I get in where I can, but the warrant business seems like we could talk more about it, and we got time to discuss it. It's not like, it is kind of strange though, if people actually knew what was going on with it. It goes back at least 4 years. Well, it goes back to the election of the former treasurer, actually, because it was contentious from the get-go. While I never really knew her well, but I did sit in meetings where she was, and her main complaint always was that the city's investments are not returning what they should be returning. We can do better. Well, that's something to listen to.
Yeah.
Now, whether she was right or wrong, I don't know. But it's you know, it's worthy that someone is saying, oh, we could do better. But I think, well, I don't think, I know she just got herself in huge trouble with the city council, in particular, one member, maybe more, but at least one member. It didn't work out at all. So they just started penciling that person out. And that's what happened. So until she, as I say, being redundant, but until she finally resigned.
So what do you do now as the treasurer?
Well, when the city, I attend the city council meetings and try to pay attention to what's going on and try to help out in the city where I can and this kind of thing, but just as a citizen. I do look at every report, take them apart, sort of, not line by line. But the first, how did we get here? And my suggestion right at the point is, I said to Tori, is on your headline, start off with total investments and total return. What's the percentage of that? So when anyone picks up a report, and that's not one of the reports, the reports are 100 pages long or more, right, Tori?
That's correct.
And so you're not going to go through 110 pages. You just don't have time to do that. Besides, we're second guessing these guys. So what you do is, if you put that as a headline right up here, here's our total investments, our return, and that's an estimated annual return in simple terms. You know what I'm saying? It's an estimated annual return. Now, you or myself, anyone, if she did that, I would have no reason to go on the computer other than just to download the report. Say, oh, there we are. But as it is now, because that's not on there, it does take time to go through and see where we're at. You have to you have to go through the columns and take out the information and see where we're at. And like I said, I haven't gone all the way. I have them all downloaded from 2022, but from July of 2022. But I haven't gone through line by line on all of them. But I have looked at certain things. This morning I spent probably 4 or 5 hours looking at different aspects of it and checking out the lathe. Tori and I talked about the lathe, and we've talked about the lathe and why can we do better? And yes, we can. And so those are the kind of things that I do. But it wouldn't need to be done if that information was put on there as the headline. It's right up on top. And that goes what? Because I'm not going to second guess these guys. But I will take a look at their number, and I would recommend that our staff be checking with other cities, see how they're doing. Here's our return for the last quarter, and as you go along the last year. How are you guys doing?
Okay.
And it's important. We've come through a beautiful time where these high interest rates, you know, a lot of people right now are hurting. And it depends on the side of the economy you're on. And it looks like there's not going to be any draconian moves on the Federal Reserve in the next year. There's going to be a little movement, but it's not right now. Nobody's predicting any major movement. So for the city, now is a perfect time to have your investments tuned to the max, getting a good return, and using that towards reserves or whatever else you can use it down the line. And on the kind of money you've got in the bank, it's good. It's not bad. It's nothing to sneeze at, if you want to use an old farmer term. And we've come from 1% to 3 and 4% in some cases. And we've recently got hurt a little bit, but yeah, we're still looking real good. We're in a good market right now.
Okay. So, yeah, I think we just would want to see more information and maybe create a list of duties that would be appropriate.
Okay.
A report back that we'll bring to your next meeting.
Mm-hmm. Okay. Any other comments on that item?
None for me.
Item number 7 is the consent calendar. All consent items will be acted upon by a single action of the Board of Trustees unless otherwise requested by an individual trustee for separate consideration. And so 7A is approval of the minutes from November 30th, 2023. Since Jackie wasn't here, I'll go ahead and make a motion to approve the minutes from November 30th, 2003.
I'll second that.
20.
And I'll abstain.
Okay. So all in favor, say aye.
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 All opposed? Abstained? Yes. Okay, moving on to reports. Item number 8. 8.1 is an update from staff on local government investment pools.
So I'll go ahead and take the lead on this one. As Dale mentioned earlier, when I first got to the city, I did look at where we were, should I swing around?
No, I'm good.
Okay, all right.
I
I'm
got
sure
you.
that you're comfortable. I did note pretty quickly that we had a huge concentration in LAIF for our local government investment pool. So I reached out to Tom and Mark, our investment partner, and said, hey, I think we have a big concentration here and we're not really doing so hot on investment returns. And so in light of that, I asked, what are our options? Can we get into other investment pools that are, approved in accordance with the California state investment law that we have? And of course, Tom was like, heck yes, let's do it.
Mm-hmm.
So that's kind of where we landed. And then we brought that to the committee in November and got clear direction on what we needed to do and how we needed to get there. And so the update is, as of today, we've actually moved $30 million out of LAIF into CalTrust. And so it's 15 million for CalTrust and 15 million for California class. So we moved 30 million out of LAIF into each of those 2 local government investment pools. And we're working on getting into CAMP, which is another investment pool. We're expecting to be able to move $15 million into CAMP before the end of February, once we get our account established.
And we've done better on the one that did get switched, I
Well,
saw.
it just got switched a couple of days ago. We had a little bit of hiccups with getting the money moved into the new investment pools, but we're thinking that by the time we have our next meeting, we'll have like a snapshot of how the investments are doing in LAIF compared to how they're doing in the new investment pool. So that way we can have a little indexing there to come back and talk about and recognize.
And can you tell me what class and camp stand for?
Oh, geez, that's a pop quiz. Hold on.
Tori, do you want me to take that one?
Yes. Wait, hold on. CAMP, California Asset Management Pool, and CalTrust. I just always assumed it was CalTrust. Does it have a full?
No, CalTrust is not. CalClass stands for Cooperative Liquid Asset Security System. But yes, all 3 are stable net asset value, AAA rated liquidity options that in each case are yielding right around 5.5% versus 4% versus LAIF. So maybe at the next meeting we'll be able to dollarize a little bit on your reports, but that decision by the group is you're picking up in that pot of money an additional 1.5% or 150 basis points in additional return by making those moves.
The percentage, how much money is that? That's a lot of money.
It's a good chunk. Yep.
Yeah, because you're only, but how much is the difference on that? That's almost double.
It's 1.5% more.
Yeah, on $45 million, Dale, that's right. Mark is, I can see him, the wheels turning there, so he's gonna crank it out. So, but yeah, on an annualized basis, that's quite a bit of additional income for the portfolio. And one thing to say while Mark's calculating that, it's not that LAIF is not a good investment. It's the way LAIF is managed. They have a longer duration. You may remember this from the last commission meeting. So in a rising interest rate environment, which we just have come out of, or LAIF is going to underperform from a yield standpoint. That won't always be the case. So LAIF is still a sound investment that we think that the city should still continue to use. It's just a matter of the investment environment the interest rate environment that you're in.
Yeah, that's right, Tom. And just to put some numbers behind it, so if the city were to move the additional 15 million into CAMP, which would leave you with a $45 million or so roughly in the local government investment pools, picking up around 1.5% of extra yield. That 1.5% on $45 million works out to $675,000 per year of additional investment income, just moving from LAIF into those other AAA rated, very liquid daily liquidity pools. And again, just because of the interest rate environment and the differential between the weighted average lives and how quickly they're being able to take advantage of the higher rate environment.
And we'll be able to enjoy that yield at approximately 50% because of the timing of when we're making the moves for this fiscal year.
Yeah.
And so this is just a receive and update. So if there are no other comments, we'll move on to item 8B, an update from Public Trust Advisors on the investment portfolio. Can we get a report, please?
Take it away, gentlemen.
Thank you. Mark, do you want to go ahead and get started?
Yeah, so for the group, what I thought I would do today is just start with a brief, maybe 15-minute update on the economic and market environment. And with that as background, then transition into a discussion of what's taking place in the 1 to 3 and 1 to 5 year portfolios. As you'll recall, at our last meeting on November 3rd, the committee did again authorize us to move forward with the rebalancing of those 1 to 3 and 1 to 5 portfolios that had gotten a little bit aged, given some of the turnover at staff that had taken place. And so just as a foreshadowing, we did execute those rebalancing transactions in December. So now the portfolio strategies have been reconstituted to those 1 to 3 and 1 to 5 year strategies that were authorized by City Council. So I will get back into the portfolios after a brief market update. I'm going to go ahead and share my screen with you and just walk through, again, a 10 to 15 minute market or economic update, just as backdrop for what we're seeing in the marketplace and how that affects some of the things we're contemplating and doing within the portfolios and some of our expectations for 2024. So broadly speaking, it's the beginning of the new year. The new year is a natural time to kind of reflect upon the prior year past. So when we look back at the performance of the economy over last year, one of the things that stands out is how resilient the U.S. economy actually performed. In the third quarter of 2022, so much of the market discussion was around how deep the U.S. recession was going to be. We had just experienced 2 negative quarters of GDP growth in the first and second quarters. Expectations were that the U.S. economy was likely to fall into an official recession in 2023. That did not transpire. In fact, quite the opposite. Following those 2 quarters, the first half of the year where the economy contracted, growth really accelerated over the succeeding 4 to 5 quarters. And that resiliency was really on display in the third quarter GDP results, which are the most recent available to us. We'll get the update on the first quarter at the end of this month. But through the third quarter ended September 30th, the economy grew at a much stronger 4.9% annualized pace. And it was just significant acceleration relative to the prior 2 quarters. In fact, it was a little bit more than double the pace of growth that we experienced in the prior 2 quarters. However, that GDP growth in the third quarter is, of course, backward looking. As we look forward into the current quarter ended December 31st and out into the first and second quarters of this year, growth is expected to have moderated pretty significantly in light of a couple of different factors. Of course, higher interest rates for the Fed, that is restraining, financial conditions to some extent, making, the cost of capital higher. In addition to that, we don't have the same level of fiscal stimulus kicking in and helping the consumer as we did in 2022 and in parts of 2023. Some of the excess savings that was accumulated because of that fiscal stimulus has been depleted, will not be a tailwind to consumption for the U.S. economy in the year ahead. And consumer spending accounts for about 2/3 of overall GDP growth in the United States. So we don't have those tailwinds feeding growth in the year ahead as we did throughout much of 2023. In addition to that, we have the resumption of loan. It's going to be a little bit of a headwind to consumer spending, as well as we are starting to see signs of stress in other areas of the economy, in particular in credit card delinquencies. So there are a lot of signs that growth is expected to slow pretty considerably, especially in the first half of 2024. A little bit of payback so to speak, for that very strong performance that we saw in the third quarter. There are warning signs flashing in certain segments of the markets. You look at the ISM Manufacturing Index; it's been in contraction for one of its longest stretches in history. Another indicator that we're following pretty closely is what's called the Index of Leading Economic Indicators, composite of 10 different financial market and economic indicators that has a historically very tight correlation with turning points in U.S. Economic activity. And the current stretch of negative performance in that Index of Leading Economic Indicators correlates very strongly with periods of economic recession in the past. So this is not necessarily a recession call. There is still the potential, so to speak, for a so-called soft landing, where the Federal Reserve, having raised rates as aggressively as they have, perhaps, with the labor market strength that we've enjoyed through the last couple of years, if that is able to kind of blunt the effects of higher interest rates and help the economy achieve that so-called soft landing, that remains to be seen. And there are certainly varying opinions within the marketplace about that. But again, highlighting one area of weakness in particular, this Index of Leading Economic Indicators through November, which was the most recent available when these materials were published, had contracted for 20 consecutive months. That's a stretch that is generally correlated with periods of economic recession. Anytime you see great bar charts on our graphs, those indicate periods of recession. So this current stretch of now 21, because we got an update just a week ago for the December readings, also came in negative. So that stretch is now extended to 21 months of negative contraction in this particular index. Again, we're presenting just this one. There's a host of others that we could point to that are flashing these warning signals that growth is likely to slow as the economic cycle kind of reaches an inflection point. I noted some of the strain on the consumer. We are starting to see those effects of higher interest rates, fading fiscal stimulus weighing on the consumer. What we're looking at here is just delinquency rates on credit cards. The blue line represents the delinquency rates on credit cards issued by the 100 largest banks in the United States at just under 3%. It's not yet at levels that have been associated with recession, but it is trending higher. Credit card balances are at all-time highs at the same time that credit card rates are at all-time highs. That is beginning to have effect on consumers. We're seeing that in these rising delinquency rates. By contrast, we do feel like the working class cohort is starting to feel the pain a little bit more acutely. In particular, if you look at the delinquency rates for credit cards issued by banks that are not within the 100 largest, that typically cater to less creditworthy consumers, those delinquency rates up at 7.5% are starting to get quite elevated. And again, just a sign of these stresses building within the economy, in part because of the very aggressive interest rate increases by the Fed. Certainly, the resiliency of the economy we've enjoyed through the last year has been in large part a function of the strength in the labor markets. In December, we added a larger than expected 216,000 jobs. Of course, the pace of job creation is expected to slow coming out of 2021 and 2022, when in large part we were re-adding many of those jobs that were kind of lost during the pandemic. We saw a very outsized pace of job creation. That was really jobs being re-added that were lost during the pandemic. And we're now settling into what we call a more sustainable rate of job creation. But the trend is cooling. And this is going to be just another the economy that's fading in 2023. That source of job creation that drove us in 2023 is going to be a little bit slower. It's going to be a little bit less tailwind to the economy as we look into 2024. Of particular note, however, and just sticking with the December number surprised to the upside, but in large part the report was a wash. We'd had downward revisions of I think 71,000 cumulatively to the prior 2 months. So we're in this kind of choppy period where the data in the labor markets is starting to show some signs of slowdown, kind of consistent with that theme that I noted previously. For its part, the unemployment rate remains very subdued at 3.7%. The labor market and this concept of labor scarcity, at least our thesis at PTA, is one of the reasons that the job market hasn't responded with the level of layoffs that we may have seen given the very aggressive rate increases from the Fed in the past. 525 basis points of rate hikes crammed into roughly 12 months. We would have expected employers to start increasing the rate of layoffs or separations from employees. That hasn't been the case. At 3.7%, the unemployment rate is very low still by historical standards. We think what's happening is employers are choosing to retain headcount for longer this cycle for fear of not being able to replace them in the future, because labor scarcity continues to be a persistent issue that many businesses are facing. And that retention of labor has helped, we think, support the broader economy and helped that recession that was so expected in 2022 not manifest in 2023 because of that persistent labor market strength. Just a couple of other updates on the labor market, just evidencing that the cooling that we are seeing and that we think will bring into play potentially some Fed rate cuts in 2024. In particular, the level of job openings has decreased fairly significantly from its post-pandemic high. In addition to that, we're also seeing the quits rate has moderated while back down to pre-pandemic levels. The quits rate measures the percentage of the workforce that is voluntarily leaving their job, generally in pursuit of higher paying work elsewhere. And it's kind of the intuition is that when the quits rate is high, employees perceive the labor markets as very strong. They perceive their ability to find gainful employment at higher rates of compensation elsewhere. They're very confident in making that choice to leave. So when the quits rate begins to fall, that's a sign that employees are getting a little bit less confident in the labor market conditions, in their ability to replace that job. So we've normalized on the quits rate back down to pre-pandemic levels. In addition to that, as I noted previously, we saw that the unemployment rate is still very historically low at 3.7%. Another metric that we follow pretty closely is what's called the layoffs and discharge rate. It measures involuntary separations, or the percentage of the labor force that is being let go by their employer in any period, and it remains at very historically subdued levels, just down at roughly 1% through October, which was the most recent data when the year was published. And again, reinforcing this concept of labor market scarcity, this theme of employers retaining headcount for longer does seem to be a pillar of support to the labor markets, at least over the last couple of years. Switching gears a little bit, if the labor markets have been a pillar of strength for the economy, inflation had been obviously a clear and present danger through much of 2022 and 2023. We began to get some relief. Through November, we saw the consumer price index fall to 3.1% on a year-over-year basis. The core, or excluding food and energy, CPI actually had fallen down to 4% through November. We got an update to the December CPI data that was, again, not available when these reports were published. But in December, both headline and core CPI increased by 0.3%, and that pushed up the year-over-year rate for headline CPI to 3.4% from 3.1%. Core CPI still fell from 4% down to 3.9%. And, directionally, inflation is moving in the right direction. It is headed down. The Fed wants to get it down sustainably to their so-called 2% target. That last mile of getting inflation down to 2% on a sustainable basis we think is going to be a little bit more challenging. Some of the forces driving this rate of disinflation that we've seen to this point have been fading food and energy costs, the crisis in Ukraine. Those immediate increases in food and energy prices have been abating. Inflation figures have gotten some relief. And it's turning out to be a little bit more sticky in this last, percent or two down to the Fed's 2% target. And just anecdotally, a couple of thoughts on, how bumpy that road to 2% from the Federal Reserve's perspective, may be. Just anecdotally, here in California, we have the insurance, problems that we're going through. And in fact, State Farm, which is the largest provider in the state, just announced plans a couple of weeks ago to increase, in addition to not issuing any more policies, they're raising rates for current policy holders for 2024, home and auto, by 20%. In addition to that, the National Federation of Independent Businesses, they published a small business sentiment survey. The proportion of small businesses that are planning price increases has been trending higher now for like 6 months. And so we think there are some still, latent inflation pressures within the system that might make this last leg down to 2% a little bit of a choppy road. We're moving in the right direction. It may just not be perhaps as quickly as the Fed would like. Speaking of the Fed, they held rates at their FOMC meeting, so the policy rate still is in that range of between 5.25% and 5.5%. That was not a surprise. The Fed's decision to keep rates unchanged was widely expected. What was not expected was what has been deemed kind of a dovish tilt in the Federal Reserve's expectations for future rate policy. And not to get too deeply into the weeds on this, but as part of their quarterly updates, one of the things that the Federal Reserve releases are their summary economic projections, and they reflect the voting FOMC members' forecasts for expected rates of growth for the U.S. economy, expected rates of inflation for the U.S. economy, and the expected appropriate Fed funds rate over the next couple of years. So at year-end 2024, 2025, 26, and for the longer term, the voting members of the FOMC provide projections of where they think those variables will be. Well, in a surprise that was not expected by market participants at their December meeting, the median forecast of the Federal Reserve's projections for where they thought the the Fed funds rate would be at the end of 2024 included one more rate hike than the market was expecting. So the Federal Reserve's own projections released in December as part of their policy statement project the Fed cutting interest rates by 325 basis point increments in 2024. The market was anticipating the Fed was going to project out 2. So that sparked a little bit of a rally in bond markets, which set interest rates lower. So one of the other things we follow very closely is something called the Fed funds futures market. What it simply is a futures market where investors can buy contracts based upon where they believe the Fed funds rate will actually be at various points in the future. So the dark blue line on top represents where the market expects the Fed funds rate to be between January of 2024 out to January of 2025 as of last quarter ended September 30th. Well, flash forward to this quarter ended in December, and fueled by a couple of things: economic data beginning to slow, and the Federal Reserve's kind of dovish tilt with respect to their policy expectations. We saw the market's expectations of where short-term interest rate policy would be shift dramatically lower in over the course of that quarter. And so if you just look at July of 2024, the market is now expecting the policy rate to be 75 basis points lower than they thought it was going to be back in September. And similarly, at the end of 2024, the market is expecting the policy rate to be almost 90 basis points or 0.9% lower than where they thought it was going to be in September. So that's a fairly significant shift in the market's expectations of rate policy that took place in this fourth quarter. And that has had a fairly significant effect on bond markets, as you would anticipate. So keep in mind, in terms of setting monetary policy, the Federal Reserve only controls very short-term interest rates. Typically, 6 months in on the yield curve are going to trade in very tight correlation with the Fed's policy actions. So when the Fed raises rates, short-term rates 6 months in will increase commensurately. When the Fed cuts rates, those same short-term interest rates will decline commensurately with the Fed's rate cut. As we move further out the yield curve, 1 year, 2 year, 3 year, 4 year, those rates tend to trade more correlated with respect to expectations about what the Fed is going to do in the future. And then as we move out 7 years, 10 years and longer, that portion of the yield curve tends to trade with respect to expectations about future growth, future inflation, and the interactions with current Fed policy. So that belly, as we call it, of the yield curve, 1 to 5 years, which is the sweet spot, California State Code, and for the program, those rates shifted dramatically lower over the quarter. In fact, you can between 1 year and 5 years, which kind of captures your current 1 to 3 and 1 to 5 maturity ranges for the two strategies. Those rates shifted lower by 70 basis points, between 70 and 80 basis points. And again, this is before the Federal Reserve has done anything to cut interest rates. This is the market beginning to price in those expectations of those rate cuts. So for fear that rates will be lower going forward, investors are buying these intermediate maturities, driving their rates lower in advance of those, or in advance and in expectation of those rate cuts to come from the Fed. And that has had significant impact in a couple of areas in terms of the city's portfolio that I'll speak to when we go through the portfolios. And last slide here that I think will provide helpful context as we talk through particularly the asset allocation thoughts on the portfolio. This is just a quick look at yield spreads on certain sectors, certain fixed income sectors outside of relative to U.S. Treasuries that are, some of which are available by your investment policy and state statute. The BBB index we provide just as a measure of kind of the market's perceptions of what's happening in the lowest ring of the investment grade bond markets, kind of as a sentiment indicator about how the markets are perceiving kind of credit risk. So I'll just call out a couple of metrics to your attention, and then I'll refer back to those as we talk to the kind of asset allocation and perhaps some of our thoughts looking ahead with respect to portfolio strategy. The first thing I wanted to call out is the first line item are U.S. agencies. So the two government sectors are U.S. Treasury securities and U.S. agency or government-sponsored enterprises. Agencies have been very, very low, roughly mid-single digits for the last several years, and they got down extremely low over the course of the fourth quarter. In fact, relative to U.S. Treasuries, you'd be lucky to find 3 to 4 basis points, 0.03, 0.04% of additional yield. So agency securities is not a sector that we're particularly constructive on right now because you're not picking up virtually any additional yield relative to U.S. Treasuries. In the corporate bond market, here we're looking at the spread on kind of an average of U.S. corporations rated in the single A to triple A categories. They closed the quarter at a yield spread of 66 basis points or 0.66% above U.S. Treasuries. But over the quarter, they rallied very significantly, coming down 16 basis points from the prior quarters or from the prior quarter, and well below the average over the last 12 months of around 80 basis points. So at present, they're trading relatively rich, expensive, so to speak, to levels they've been trading at over the past 12 months. And when we look back over a longer look back period, say that last 3 years and the last 5 years, they're right around that average of the past 3 years and the past 5 years. So we currently view the U.S. corporate sector as being a little bit rich, particularly given growing expectations that the U.S. economy is likely to slow in 2024. We think that puts pressure on corporate balance sheets and corporate profit margins. We think it's likely that these spreads widen from their current levels, particularly given the significant tightening that we experienced during the third quarter and given our macroeconomic outlook for 2024. So that is not to say that we're recommending avoiding the space. There is still additional income available, but we are not advocating for increasing that allocation to your policy maximum or to the state statutory maximum of 30%. We would likely look to begin increasing your current allocations, perhaps taking them up to around 50%. Take advantage of that yield spread that's available, but keeping some capacity or some dry powder, so to speak, to increase that allocation in the future at what we think will be more attractive entry opportunities. If we were to increase that allocation to a policy maximum currently, and we have that scenario where those spreads relative to treasuries become wider, more attractive, we would not have any capital to take advantage of that opportunity. So we're advocating for increasing the current corporate allocation to take advantage of the spread that is there presently, but keeping capacity about 50% of your policy allowance to increase that allocation at points in the future that we think is going to be more opportune, provide better what we call relative value in the space. And again, I mentioned we're looking at the BBBs here just as a sense of market sentiment. And so at least as of the quarter ended December 30th, the market is pricing these expectations of recession, but that Goldilocks scenario of a potential soft landing, at least with respect to credit spreads, seems to be in place because we're not seeing the less credit-worthy credits begin to be traded at higher yield premiums. The market is still willing to take those credits at compared to history, at least, relatively expensive levels. So a sign that there's still some confidence in the outlook for the corporate bond market. We think that supports increasing your corporate bond allocation a little bit from current levels, But again, and as I mentioned, keeping it below the 30% policy max. So I'll come back to that as we actually go through the portfolios. But I wanted to spend some time on the spread section because this will feed into our discussion on the asset allocation in the portfolios. So with that, I'm going to pause my market update comments, and then we'll jump into the reports. Are there any questions for you at this time?
Because I don't have a background in finance or investments, can you explain the dovish tilt or?
Oh, sure. Yeah, that's a great question. And I apologize. I do this 24/7 for 30 years.
I'm a planner. I use acronyms and people don't know what I'm talking about.
So when we speak about monetary policy, the two phrases that are commonly used are called dovish and hawkish to describe the stance of the Federal Reserve's policy posture. When we say that when we make reference to dovish, that means the committee is more inclined to reducing interest rates, to making monetary policy conditions more accommodative. Conversely, if we say hawkish, that means the committee may be a little bit more concerned about the inflationary impulse, and therefore they may be beginning to tilt policy in a way that we would be more inclined to increase interest rates and tighten monetary conditions. So dovish tilt is the opposite, where they're beginning to be concerned less about inflation, perhaps more concerned about future growth, and therefore becoming more inclined to consider reducing interest rates in the future.
Okay, perfect.
It's kind of like the bulls and the bear.
Exactly.
You got it right on the head, Jackie.
All right.
It's a great question, and thank you for it.
Any other questions?
Not for me.
All right, let's move on to 8B.
Or in 8B, he's going to give you an update on our actual portfolio now that he's talked about the global economic update.
Okay.
Okay, so we'll start with the 1 to 3 portfolio, and these are the reports that are included in your agenda packets. So we'll start again with the 1 to 3 portfolio, and I'm just going to go to page number 3 at the bottom of your printed documents. Just a quick update on the portfolio characteristics. And just as a refresher, at the last committee meeting, we had talked about extending the average maturity, the average duration of the portfolio. So I'm just going to call your attention to the upper leftmost box and go through some of those portfolio characteristics. Maybe take this as an opportunity to refresh our understanding of what these metrics mean, and that will provide context as we move through the remainder of the report. So starting with the duration is very closely linked to the average maturity of the portfolio, but duration is a measure of interest rate sensitivity, and it tells us something very specific and something very important. The duration tells us the percentage by which the portfolio's market value would change given a immediate 100 basis point or 1% change in the yield curve. So if interest rates were to shift higher by 1%, a duration of 1.74 at December 31st would mean that the portfolio's market value would decline by 1.74%. And conversely, if interest rates were to decline by 1%, then the portfolio's market value would increase by 1.74%. So it's very closely linked to the concept of maturity. It is very close to the concept of average maturity, but it tells us a very specific metric in terms of the sensitivity of the portfolio to interest rate changes. It's a very important metric from a risk management perspective. And how we use the duration is we manage it versus the selected benchmarks. So the benchmarks that are assigned to this portfolio also have durations, and we're looking to align the portfolio's interest rate sensitivity to those 1 to 3 and 1 to 5 year strategies so that the portfolio delivers the strategy that was selected by City Council. And so not doing those rebalancing transactions, for example, resulted in the portfolio getting a little bit more aged. Its average life had fallen down to about 1.5%. So with the committee's authorization at our last meeting, we did execute those rebalancing trades, extended the portfolio's maturity duration out towards its targeted level, consistent with the 1 to 3 strategy. The years to effective maturity and years to final maturity. I'll start with the years to final maturity is just a weighted average maturity of all the securities in the portfolio, weighted by their proportionate or proportional market value within the portfolio. Effective maturity is used in the event that the portfolio contains any securities that have embedded call options. That is, options that allow the issuer to call the bonds away from you if interest rates decline. The effective maturity would capture the impact of that optionality on the maturity. There's no option-based securities in the portfolio, so those two metrics are going to be the same. The coupon rate is just a weighted average coupon for all of the fixed income securities in the portfolio. So fixed income means the bonds pay a fixed coupon. The weighted average coupon rate, the coupon rate is just a weighted average coupon of all the bonds in the portfolio. The book yield, this is, I think, going to be the more important metric for you all to think about. The book yield represents the weighted average purchase yield of all of the securities in the portfolio. And so what that tells us is kind of the expected annual income stream generated by the securities in the portfolio based upon their purchase price. So, a simple example, if we just take one bond, let's say we bought a 2-year treasury yield at a yield of 4%. That means that investment is going to provide an income stream over its life that equals 4%. Well, the book yield is just that same metric applied to the total portfolio of securities based upon the actual purchase details of each individual security. The market yield reflects the fact that obviously after their purchase, bond prices change as interest rates and yields change in the marketplace. So the market yield represents, and I'll say this one two ways, the market yield represents if we wanted to go buy this exact same portfolio of securities that exist in the portfolio today at today's market prices, at today's market values, this is the yield that it would generate. So conceptually, it's kind of like from their current market prices through their maturity dates, this is going to be the yield that is earned on the positions on a going forward basis from their current market values, which are, of course, different from their purchase prices because prices and yields are changing on a daily basis. So in one way, you can think of it as the replacement yield. It's the yield that if you were to sell this portfolio today, this is the yield you would sell this portfolio to a new purchaser at. And then now off to the right, we're just a couple of metrics. We're looking at the cost basis change in the portfolio over the quarter, the change in its book value, some accrued interest changes. One I wanted to call your attention to is the net unrealized gain loss. So for a couple of reasons, that number declined substantially in the 1 to 3 portfolio. It declined in part because of the significant decline in interest rates that we saw. So the reason that we had an unrealized loss in the portfolio was, of course, the bonds were purchased in a previously lower yielding interest rate environment. As interest rates rose, their market values declined. That means that relative to their amortized cost, they're trading below that value. So there's an unrealized loss in the portfolio. Well, obviously there's a significant change over the course of that quarter. That has to do with two things. It has to do with that significant decline that we saw in the 1 to 3 year part of the yield curve, where the 3-year portfolio resides. That caused their market values to increase, and so that unrealized loss became a little bit less. In addition to that, we moved forward with those rebalancing transactions where, again, we sold those previously purchased lower yielding securities, reinvested them at longer maturities and at higher book yields. In order to do that, a portion of those losses had to be monetized. And so that reflects the fact that that accounting loss, its market value less than its amortized cost value, was recognized in the accounting period in which the transactions were executed. But that replacement book income being significantly higher on the securities that were purchased compared to the securities that were sold is going to generate that much higher income stream and for a much longer period of time. In general, we sold bonds less than 1 year to maturity and invested out in securities maturing 2 or 3 years out. So those new higher book yields are going to be locked in for a longer period of time. So those two components, I think, explain the change, the reduction in the net unrealized loss position in the portfolio. And as interest rates decline, two things are going to happen. You're going to see that unrealized loss continue to get lower. At some point, it may change to an unrealized gain. And then the differential between the book yield and the market yield is going to get less and less. They're going to converge to be very, very close to one another as we continue to rebalance the portfolio. The 1 to 3 being a longer maturity is going to reprice, reinvest into today's higher rate environment, and you'll see convergence in that market yield relative to the book yield. And sometime in 2024, if the Fed does move to cut interest rates, we may see a inflection where now your book yield is yielding above the market. And so those will be some dynamics that will be playing out in 2024. And then quickly on the asset allocation update here, because I spent some of that time going through those yield spreads, just some thoughts on the asset allocation. And we'll see in a slide or two the change in the allocation in the portfolio over the quarter, and I'll come back to explain that. But right now you see a fairly significant allocation to the U.S. government market. This is U.S. Treasuries. That's because, again, as we'll see in a moment, we sold some U.S. agency securities to facilitate that rebalancing, because why hold the agencies if you're getting effectively the exact same yield as a U.S. Treasury? So we sold some of those U.S. agency securities, purchased U.S. Treasury securities longer on the yield curve to lock in some of those rates, get that extension of maturity and duration that we talked about accomplished. And I think one of the next phases of trades in our recommendations will be taking your corporate allocation, which is currently at 9% in this portfolio. You're allowed by state statute and by policy to take that up to 30%. As I discussed previously, we don't recommend 30% today because we think that yield spreads, are likely to increase in 2024 as the economy slows. We think that puts pressure on corporate balance sheets and corporate credit spreads to become a little bit wider. But we would be comfortable increasing that allocation up to around 15%. Because there still is some extra yield available today. We may get the yield spreads may not begin to increase until the third quarter of 2024. We don't know when the timing of that is going to be. So we want to recognize there is value in, we view corporates right now as approximately fairly valued, because their yield spreads are a little bit tight to 1 year's look back, but in line with their averages of the past 2 and 3 years. So we think a neutral allocation to your policy max, or half your policy max, would be appropriate. And then again, as I mentioned, not taking it to 30% or up towards 30% unless and until we see that widening when those spreads become more attractive at points in the future, keeping some powder dry with respect to your asset allocation to make those adjustments when we think the sector is a little bit more fairly valued. So with that, I'll move on to the next slide. And please feel free, I should say, to interject with any questions. Don't feel the need to wait until the end. If there's any questions, just please ask along the way, and I'd be happy to address them. Here we're looking at just how the market value of the total portfolio is allocated across the yield curve by asset class. So a couple of things to mention here. The first is, by design, the bulk of your market value in the 1 to 3 is going to be in the 1 to 3 year maturity buckets. So that is by design, of course, given the strategy. We do have some small allocations to some of those shorter maturities. Many of those are short-term corporate bonds. So because the corporate bonds provide a higher yield than Treasury securities, we chose to sell Treasury securities and agency securities to fund those rebalancing and retain some of those shorter-term corporate bonds because they are providing that incremental yield spread versus Treasuries, and will allow those to mature to help facilitate, along with additional rebalancing sales, the continued repositioning of the portfolio's maturity distribution. And you can see that in terms of the distribution by security type and by maturity bucket. The bulk of the positions in those shorter maturity ranges are corporate bonds and some CDs that have a little bit more yield in them. So we're choosing to retain those, sell the lower yielding Treasury securities, and we'll just reinvest those upon maturity within future rebalancing trades. I'm going to skip over this slide because it's really not relevant to your portfolio. And then just in terms of the credit ratings of the securities in the portfolio is obviously very high, has a very high credit quality, in part given its allocation to government securities. But even within the corporate space, we're in very strong credits with single A rated or between with credit ratings of between single A and triple A. You can see the distribution by rating type here. You know, the one thing I would note, and we sometimes get questions on, is, you know, you can see the from Moody's, the 48 million of market value rated AAA, and then a 48 million of market value AA by S&P. That's because S&P downgraded the U.S. credit rating back in 2011 to AA plus, so it's in the AA category, whereas Moody's still has the AAA rating on the U.S. sovereign rating. And then some of these below A or not rated, those are some of the certificates of deposit that are in the portfolio, but they are covered by FDIC insurance limits. So there's no credit risk with respect to those because they are covered by FDIC insurance. And then lastly, a little update on the evolution of the asset allocation over the quarter. I touched upon this, but I think this will provide a good graphical illustration of what took place over the quarter. The big change really had to do with through the rebalancing trades, we sold a good portion of those agency bonds because, again, there's no incremental yield to holding them versus treasuries. Those are trading down at roughly, you know, a handful of basis points, you know, over U.S. treasuries. So we elected to lighten up on those agencies and generally rotated that capital into the treasury market, along with some money market fund balances that had accumulated up prior to the rebalancings. So on a going forward basis, if we move towards increasing that corporate bond allocation a little bit, you know, at our next quarterly meeting, we would expect to see likely a decline in the treasury allocation, and, you know, maybe a 6 or 7% increase in the corporate bond allocation as we look to take that, you know, a little bit, you know, up to around the 15% or so level that I described previously. We'll skip that. I'm not going to go through the portfolio holdings because I know you've all had a chance to review. I'm certainly happy to answer any questions. And then lastly, just on the transaction stuff on page 13, this represents the rebalancing transactions that were done in December, where we sold some of those short-term securities to fund the purchase of those longer-term securities as part of that duration rebalancing that we did in December. So with that, I will pause and see if there's any questions with respect to the 1 to 3 portfolio.
So I had questions about all the losses shown or the negatives for the United States Treasury. So I think that you explained that well, but I started making notes on every page, and then I'm like, it's just kind of overall. I had questions on that, but I think I understand how we're moving forward. So otherwise, I didn't have any questions on the transaction.
Okay. All right, with that, then, if there's no further questions, I will go ahead and just switch to the 1 to 5, and I won't be as long-winded on the 1 to 5 because I think you kind of got a sense of, you know, what's taking place. It's going to be the same, you know, reasoning, rationale, strategy behind the 1 to 5, and so let me just switch over to the 1 to 5.
Thank you.
Okay, the share should be in. Back up to the beginning on this one. So yeah, here, this is the 1 to 5. So, you know, it has that longer maturity structure. So as interest rates rise, it's going to be a little bit slower to reflect those higher yields, that higher book yield into the portfolio, because it turns over more gradually, given that it is a longer term portfolio. And that's a good thing. And I'll speak to the importance of yield curve diversification maybe as a concluding point, because I think this is a really important point for the committee to keep in mind as you think about the totality of the investment program. But, you know, the same metrics, you know, the duration, maturity, coupon that we discussed on the 1 to 3. Of course, the 1 to 5 portfolio is a little bit longer term. It's going to have a strategic duration of around 2.5, 2.6 years. It had drifted down to just under 2.25 years as of last quarter end. So with the rebalancing trades this quarter, we did extend that back out to lock in these higher yields, higher book yields that are available relative to the prior security. So that had the effect of getting the duration extended out towards its intended target. Similarly, the average maturity was extended out to 2.7 years in this portfolio. The book yield increased by just about 25 basis points. So relatively a little bit less of an increase in the portfolio book yield. The 1 to 3, I think, increased by around 50 basis points if memory serves. The 1 to 5, because of its longer, maturity structure, is going to take advantage of those higher rates a little bit more slowly. But still, because of the rebalancing trades, we did see a 25 basis point increase in the book yield. Here we can also see that decline in market yields that took place. So the market yield of this portfolio as of last September was up at just north of 5%, because market interest rates declined so dramatically as we saw during the economic and market update. The market yield on this portfolio also declined back down to 4.25%, but similar to the 1 to 3, just at a slightly more gradual pace. The market yield and the book yields are going to continue to converge in the 1 to 5 portfolio, as interest rates seem to have kind of reached their cyclical peak and have been trending lower quite considerably since mid-October. Similarly, for that reason, we saw a near halving of the unrealized loss in the portfolio, down from the 1.5 million as of last quarter end to just under 800,000 as of this quarter end. Again, that's similarly due to the decline in interest rates causing market values to rise, and also some of those realized losses that we kind of took in the December accounting period, but that locked in those higher yields for a longer income, for a longer period in the 4 to 5 portfolio. We reinvested primarily in that 3 to 5 year maturity range in this portfolio. So those higher yields, the benefit of those higher book yields, is going to be locked in now for that 3 to 5 year period of time with respect to those rebalancing trades that we executed in December. A similar asset allocation here, though the 1 to 5 does hold a little bit of a higher allocation to the GSEs. That is just a legacy of some of the securities that were kind of inherited with respect to this portfolio, but still a roughly 11% or so allocation to corporate bonds. Similar to the 1 to 3, we would be comfortable taking this up to about 15% in the current market, and then again looking to increase it at points in the future as we expect the corporate spreads to become a little more attractive. Here, just looking at a maturity distribution by security type. So, of course, this being the 1 to 5, it's going to add allocations to the 4 to 5 year part of the yield curve that don't exist in the 1 to 3. This provides you with very good yield curve diversification with respect to the overall investment program for the city of Hemet. And you can see, how the different security types are allocated along the different maturity buckets in the 1 to 5 year portion of the yield curve. And then here, very similar, very highly rated portfolio overall. The differential between the Treasury ratings from Moody's and S&P, and once again, any of the unrated or below A. There doesn't seem to be anything below A, but any of the unrated bonds by either Moody's or S&P, those are all certificates of deposit that are covered by FDIC insurance limits. And I would just also say that both the 1 to 3 and the 1 to 5 year portfolio are in full compliance with both California State Code as well as the city's investment policy. And then just in terms of the changes to the asset allocation of the quarter, a very similar story here. We lightened up about 7% of the allocation to the agency or GSE space. Again, there was no incremental yield to continue to hold those versus treasuries. We liquidated those to help fund the rebalancing of the portfolio duration back out to its strategic target. And we did that primarily focused on the treasury space. So we saw that kind of shift between the agency and treasury allocations over the quarter. Similarly, I would foreshadow for next quarter, as we look to take the corporate allocations up by another 5% or so in this portfolio, we might see a 5% reduction in treasuries and a 5% or so increase in corporate bonds, when we sit down in early April. So I won't go through this, and I won't go through the holdings. I'm of course always happy to answer any questions if you have. And then again, this is just a summary of the trades that were done to facilitate rebalancing, the bottom line effects of which we already saw. So I'm again happy to answer any questions that the committee may have.
Any questions?
Well, I hope that means I did a reasonable job at explaining what's going on in the portfolio then.
You did. Like I just would love to pick your brain one day.
Yeah, I know. You know your job.
Thank you guys for the report.
Well, thank you very much.
Thank you. So our next item is adjournment. The next Hemet Investment Oversight Committee meeting will be held on Monday, April 22nd at 4 p.m. in the Sister Cities Conference Room, Hemet City Hall, second floor at 445 East Florida Avenue in Hemet, California. So we'll adjourn at 5:19.
Thank you, guys.
Thank you
Thank
all for your
you.
Thanks,
time.
everybody.
Thank you all for
Thanks.
your
Have a good
time.
night.
Have a great night, everybody.